Let me tell you something that might sound arrogant, but I believe it is true. After 40 years of managing money, after generating returns that most people consider impossible, after never having a losing year in 3 decades running my own fund, I have developed a sense for what matters and what does not. And most of what Wall Street tells you matters does not matter at all. The quarterly earnings reports, the daily market movements, the endless stream of economic data, it is noise. Almost all of it is noise. What matters is identifying the handful of truly transformational forces that will shape the next 2 decades and positioning yourself to benefit from them. That is what I have done my entire career. That is how I help generate billions in profits. And that is what I am going to share with you today if I had to pick only 3 assets to own for the next 20 years. 3 investments that I would put my money into and not touch until 2046. These are the 3 I would choose. Let me take you back to 1992, because that year taught me everything I need to know about finding asymmetric opportunities. I was working alongside George Soros at the Quantum Fund, and we had been studying the European exchange rate mechanism for months. This was a system where European currencies were supposed to stay within certain ranges relative to each other. The British pound was locked into this system, and the Bank of England was committed to defending it. But here is what we saw that others missed. The British economy was in recession. Unemployment was rising. The government needed lower interest rates to stimulate growth. But to defend the pound in the exchange rate mechanism, they had to keep interest rates high. This was an impossible contradiction. Something had to give. Either Britain would abandon its commitment to the exchange rate mechanism, or it would drive its economy deeper into recession to defend an arbitrary currency peg. We started building our position in early 1992, slowly at first, testing the waters, then more aggressively as our conviction grew. By September, we had accumulated a position of approximately $10 billion against the British pound. 10 billion. This was not a hedge. This was not a diversified bet. This was concentrated conviction based on fundamental analysis that told us the outcome was nearly certain. I remember the tension in the office during those final days. We were watching the Bank of England desperately trying to defend the pound. They raised interest rates from 10% to 12%. Then to 15% in a single day. They were burning through their foreign currency reserves at an astonishing rate, and we knew they could not keep it up. The math simply did not work. They would run out of reserves before they could restore confidence in the currency. There was a moment on September 16th when I was not sure if we had sized the position correctly, not because the analysis was wrong, but because the magnitude of the dislocation was so large. We were betting against one of the largest central banks in the world. The potential for them to do something unexpected, something irrational, was always present. But I had learned over my career that you cannot let fear of the unknown prevent you from acting on what you do know. And we knew the British position was untenable. On September 16th, Black Wednesday, the Bank of England capitulated. They could not defend the pound any longer in a single day. We made over $1 billion in profit. Some estimates put the total gains from that trade at closer to $2 billion when you include all the related positions. It remains one of the most profitable single trades in financial history. I tell you this story not to boast. I tell you because it illustrates something crucial about how I think about investing. The biggest returns do not come from diversification. They do not come from spreading your money across dozens of assets, hoping some of them work out. They come from identifying situations where the fundamentals are overwhelmingly in your favor, where the potential reward dramatically outweighs the risk, and then having the courage to concentrate your capital. That is exactly what I am doing with the three assets I am about to share with you. Each of them represents a fundamental force that I believe will reshape the global economy over the next 2 decades. Each of them offers asymmetric return potential, and together they provide enough diversification across different drivers of value that you are not dependent on any single outcome being correct. Here is how I am going to structure this for you. I will walk you through each of the three assets, explain why I believe it will outperform over the next 20 years, give you the historical context that informs my thinking, and address the biggest objections you might have. By the end, you will understand not just what I would own, but why I would own it. And that understanding is far more valuable than any specific recommendation. The first asset I would own for the next 20 years is gold. Now, I know what many of you are thinking. Gold does not produce anything. It does not pay dividends. It just sits there. Warren Buffett has said he would rather own farmland or businesses than gold. And in normal times, I would agree with him. But we are not in normal times. We are in a period of fiscal recklessness that I have never seen in my 40 years of managing money. And gold is the one asset that governments cannot print. Let me explain what I mean by fiscal recklessness. The United States government is currently running deficits of approximately $2 trillion per year. Not during a war, not during a depression, just normal peacetime operations. The national debt has exploded from about $5 trillion in 2000 to over $35 trillion today. Interest payments alone now exceed $1 trillion annually. This is more than we spend on defense, more than we spend on Medicare. I have studied monetary history extensively. I have looked at what happens when governments accumulate debts they cannot realistically repay. And the pattern is always the same. They inflate their way out. They devalue the currency. They reduce the real burden of the debt by making each dollar worth less. This is not speculation. This is what governments have done throughout history when faced with unsustainable debt burdens. In the 1940s, the United States had accumulated massive debt from World War II. Debt to GDP was even higher than it is today. How did we deal with it? We kept interest rates artificially low while allowing inflation to run. This is called financial repression. It transfers wealth from savers and bondholders to the government, and it is exactly what I expect to happen again over the next 2 decades. Gold protects you from this outcome because gold cannot be printed. When the Federal Reserve creates trillions of dollars out of thin air, they dilute the value of every existing dollar, but they cannot dilute gold. The total amount of gold above ground increases by only about 1.5% per year from mining. That is nothing compared to how fast governments can create money when they need to. I first started accumulating gold back in 2000 at the time. It was trading around $250 per ounce. Everyone told me I was crazy. Gold had been in a bear market for 20 years. It was a barbarous relic. It had no place in a modern portfolio, but I could see the trajectory of government finances. I could see that the United States was heading toward a debt crisis, and I knew that when that crisis arrived, gold would be the one asset that people fled to. By 2011, gold had risen to over $1,900 per ounce. That is more than a 7-fold increase in 11 years. And then it pulled back, as all assets do after big runs. People said the gold bull market was over. They said I should sell, but I held on because nothing had changed about the fundamental case. Government debt continued to grow. Deficits continued to widen. The underlying dynamics that make gold attractive remained in place. Today, gold is trading above $2,000 per ounce, and I believe this is still early in the move over the next 20 years as the United States and other developed nations are forced to reckon with their debt burdens, as inflation becomes the tool of choice for reducing those burdens, gold will continue to appreciate. I would not be surprised to see gold at $5,000 per ounce by 2035. Perhaps higher central banks around the world understand this dynamic, which is why they have been accumulating gold at the fastest pace in decades. China has been buying consistently. Russia has been buying. India, Turkey, Poland, Singapore. These countries see what is happening to the dollar-based financial system, and they are diversifying their reserves into gold. When central banks buy gold, they are telling you something important about how they view the future of fiat currencies. I also pay attention to what is happening with BRICS nations discussing alternatives to the dollar for international trade. These discussions may or may not lead anywhere in the short term, but the fact that they are happening at all tells you that confidence in the dollar-dominated system is eroding. Countries are looking for alternatives. Gold has been a store of value for 5,000 years. It does not require any government's promise or any central bank's credibility. That is precisely why it becomes attractive when confidence in governments and central banks declines. Let me address the main objection to gold, which is that it does not produce anything. This is true. Gold does not generate cash flow. It does not pay dividends. It does not create jobs or build products in normal times. This is a significant disadvantage. You would be better off owning productive businesses that compound their earnings over time. But gold is not meant to be your entire portfolio. Gold is insurance. It is protection against the specific scenario where governments debase their currencies. In that scenario, the cash flows from your other investments may be worth less in real terms, even as the nominal numbers look good. Gold preserves purchasing power when paper currencies do not. I recommend allocating between 10 and 20% of your portfolio to gold, not more, because you want the majority of your wealth in productive assets, but not less because the insurance value is real and the scenario I am describing is increasingly likely. The second asset I would own for the next 20 years is artificial intelligence infrastructure. And by this, I do not mean buying individual AI companies that might or might not survive the competition. I mean owning the picks and shovels of the AI revolution, the semiconductor companies, the cloud computing providers, the companies that will profit regardless of which specific AI applications succeed. I have been investing for over 40 years, and I can count on one hand the number of technological shifts I have seen that truly transformed the economy. The personal computer in the 1980s, the internet in the 1990s, the smartphone in the 2000s, and now artificial intelligence. Each of these shifts created enormous wealth for investors who positioned themselves correctly. And each of them was dismissed as hype or a bubble by people who failed to understand the magnitude of what was happening. Let me tell you about my experience with the internet boom and bust, because it is directly relevant to how I think about AI today. In the late 1990s, I was heavily invested in technology stocks. I could see that the internet was going to change everything. The way we shop, the way we communicate, the way we access information. The potential was obvious to anyone paying attention. But I also knew that not every internet company would survive. Most of them would fail. The question was which ones would emerge as the winners. And that is where I made my money, not by buying every .com stock I could find, but by focusing on the infrastructure layer. The Ciscos and the Intels that sold the equipment every internet company needed, the Microsofts that provided the software. These companies made money regardless of which websites succeeded or failed. When the bubble burst in 2000, Many internet stocks went to zero. Investors who had bought the hype without understanding the fundamentals were wiped out. But the infrastructure companies, while they certainly suffered during the crash, survived and eventually thrived because the internet itself was real. The transformation was real. The collapse was about valuations and speculation, not about the underlying technology being wrong. I see the same dynamic playing out with artificial intelligence today. There is tremendous hype. Valuations for some AI companies are absurd. Many of the startups being funded today will fail, but the underlying technology is real. The transformation is real, and the companies that provide the infrastructure will profit regardless of which specific applications win. NVIDIA is the clearest example of this. Every AI system, whether it is from Google or Microsoft or OpenAI or some startup nobody has heard of, runs on NVIDIA chips. When I first started buying NVIDIA in 2019, people questioned why I was investing in a gaming company. They did not understand that NVIDIA had positioned itself as the essential supplier for the AI revolution. Every dollar spent on AI training ultimately flows through NVIDIA's products. The numbers are staggering. NVIDIA's data center revenue has grown from essentially nothing a decade ago to over $40 billion annually. And this is still early. The total investment in AI infrastructure over the next decade will likely exceed $1 trillion. Data centers are being built across the world. Hyperscale computing facilities that require billions of dollars in semiconductors, power infrastructure, and cooling systems. All of this spending flows to a relatively small number of companies that dominate the supply chain. I am also watching the power dynamics closely. AI is incredibly energy intensive. Training large language models requires enormous amounts of electricity. The International Energy Agency estimates that data center power consumption could double or triple over the next decade. This creates opportunities in utility companies, grid infrastructure, and even nuclear power. Microsoft recently signed a deal to restart a nuclear reactor specifically to power their data centers. When one of the largest technology companies in the world is restarting nuclear plants to meet their energy needs, this is a real constraint that will require massive investment to address. But I would not recommend putting all your AI infrastructure allocation into a single company. Diversify across the ecosystem. Own NVIDIA for chips. Own TSMC for manufacturing. Own the cloud providers like Amazon and Microsoft who are building the data centers where AI runs. Own the power companies that supply electricity to those data centers. Think about the entire supply chain and own pieces throughout. Over the next 20 years, AI will transform virtually every industry: healthcare, transportation, finance, manufacturing, legal services, creative work. The productivity gains will be enormous, and the companies that provide the infrastructure for this transformation will capture trillions of dollars in value. I am allocating approximately 40% of my long-term portfolio to AI infrastructure. This is a large allocation, and it reflects my conviction that this is the most important economic shift of our lifetimes. Not since the Industrial Revolution has a technology had this much potential to reshape how humans work and live. The third asset I would own for the next 20 years is Japanese equities. Now, this might surprise you. Japan has been synonymous with disappointing investment returns for over 3 decades. If you bought Japanese stocks at their peak in 1989, you spent the next 30 years watching them go nowhere, while American stocks compounded relentlessly. Japan has become the ultimate example of how a market can stay depressed forever. But I believe Japan is at an inflection point, and the opportunity is precisely because so many investors have given up on it. Let me explain what has changed and why I think the next 20 years will look very different from the last 30. First, corporate governance in Japan has fundamentally transformed. For decades, Japanese companies prioritized stability over returns. They hoarded cash. They maintained cross-shareholdings with other companies that served no economic purpose. They ignored shareholders and focused on protecting management. This destroyed value systematically. Starting around 2015, the Japanese government began pushing reforms. They introduced stewardship codes requiring institutional investors to engage with companies. They created corporate governance codes requiring companies to explain their strategies and justify their balance sheet decisions. They pressured companies to unwind cross-shareholdings and return excess cash to shareholders. The results have been dramatic. Dividend payouts have increased significantly. Share buybacks have surged. Companies are selling non-core assets and returning the proceeds. Return on equity, the key measure of how efficiently companies use shareholder capital, has improved from low single digits to levels approaching American companies. This is a structural change, not a temporary blip second. The Japanese yen has weakened substantially, making Japanese exports more competitive globally. When I look at Japanese manufacturers, their quality is world-class, their technology is advanced. Their only problem for years was that a strong yen made their products too expensive. With the yen now at levels not seen since the 1980s, Japanese exporters are in a position of strength they have not enjoyed in decades. Third, inflation has returned to Japan after decades of deflation. This might sound like a negative, but for stocks it is actually positive. Deflation destroys equity returns because revenues and profits decline in nominal terms. Inflation, especially moderate inflation, tends to be good for equities because companies can raise prices while their debts remain fixed. Japan is finally escaping the deflationary trap that held back its stock market for so long. Fourth, and this is perhaps most important, valuations remain attractive despite the recent rally. Japanese stocks trade at significant discounts to American stocks on virtually every metric: price to earnings, price to book, dividend yield. If you believe corporate governance improvements will continue, if you believe Japanese companies will increasingly return capital to shareholders, then you are buying those improvements at a much cheaper price than equivalent improvements would cost in the United States. Consider this comparison. Many Japanese companies trade at price-to-book ratios below 1. This means you can buy the company for less than the accounting value of its assets. In the United States, similar quality companies trade at 2, 3, or 4 times book value. Even if Japanese companies only close half the valuation gap with their American peers, you would see substantial appreciation purely from multiple expansion. Add in earnings growth and increasing shareholder returns, and the total return potential is significant. The Warren Buffett effect is also real. When Buffett announced his investments in Japanese trading houses in 2020, it brought international attention to the Japanese market. Other institutional investors followed. Capital flows into Japanese equities have accelerated. This creates a virtuous cycle where rising prices bring more attention, which brings more capital, which pushes prices higher. We may be in the early stages of a multi-year re-rating of Japanese equities. I remember visiting Tokyo in 2016 and meeting with company management teams. The change in attitude was palpable. Executives who had previously dismissed shareholder concerns were now talking about return on equity, capital allocation, and creating shareholder value One CEO told me that the days of Japanese companies treating shareholders as an afterthought were over. At the time, I was skeptical. I had heard similar promises before, but looking back, he was right. The transformation has been real. I am allocating approximately 30% of my long-term portfolio to Japanese equities, with a focus on companies that have demonstrated commitment to corporate governance improvements and shareholder returns. This includes major exporters benefiting from yen weakness, financial companies benefiting from the end of negative interest rates, and smaller companies where the governance reforms are creating the most dramatic changes. Let me bring these three assets together and explain the deeper logic that connects them. Because this is not just about picking three random investments. There is a coherent worldview that underlies all three choices. The first principle is that we are living through a period of profound transformation in the global economic order. The American fiscal position is deteriorating in ways that will eventually force major adjustments, either through inflation, currency devaluation, or both. This is why I own gold. At the same time, technology is advancing at a pace that will create enormous productivity gains for societies that embrace it. This is why I own AI infrastructure, and capital is increasingly flowing to markets that offer value and improvement rather than just paying premium prices for American assets. This is why I own Japan. The second principle is concentration. I have never believed in over-diversification. If you own 50 different assets in roughly equal weights, you are guaranteeing yourself mediocre returns. You might avoid catastrophic losses, but you will also avoid exceptional gains. The investors I admire, the ones who have built real wealth over decades, have all been willing to concentrate when they had conviction. These three assets represent my conviction about the most important forces shaping the next 2 decades. I would rather own meaningful positions in 3 areas where I have strong views than spread my capital across 20 areas where I have no particular insight. The third principle is patience. These are not trades for the next quarter or the next year. These are positions I would hold for 20 years. There will be periods when each of them underperforms. Gold might decline for several years before fiscal realities reassert themselves. AI stocks might crash as euphoria gives way to disappointment. Japanese stocks might sell off during global risk aversion. None of that would change my long-term thesis. I have learned through decades of experience that the best investments often look the worst in the short term. When I bought distressed assets during financial crises, they kept falling after I bought them. When I made the pound trade, we lost money for months before the payoff came. This is the nature of investing with conviction. You have to be willing to look wrong in the short term to be right in the long term. The mistake most investors make is confusing short-term price movements with fundamental value. They buy when prices are high because they feel good about recent performance. They sell when prices are low because they feel bad about recent losses. This is exactly backwards. If the fundamental case for an investment remains intact, price weakness is an opportunity to buy more, not a signal to sell. I also want to address the question of timing. People always ask, when is the right time to buy? My answer is that if you are investing for 20 years, the exact entry point matters far less than you think. Whether you buy gold at $2,000 or $2,200, if it goes to $5,000 over 20 years, you will have done very well either way. The same is true for stocks. Perfect timing is impossible. What matters is having the right assets in the right time horizon. Let me share how I would actually implement this strategy if I were starting today with a significant portfolio. I would put roughly 20% gold and gold-related investments. This includes physical gold, gold ETFs, and select gold mining companies with strong balance sheets and low production costs. The mining companies offer leverage to gold prices, meaning they go up more when gold rises. But they also carry operational risks that physical gold does not. I would put roughly 40% into AI infrastructure. This would include NVIDIA, TSMC, and other semiconductor companies. It would include cloud providers like Amazon Web Services, Microsoft Azure, and Google Cloud. It would include data center REITs that own the physical facilities where AI runs. And it would include power companies that supply electricity to these data centers. The key is owning the entire ecosystem, not betting on a single company. I would put roughly 30% into Japanese equities. This would include broad index funds for baseline exposure, plus individual companies that I find particularly attractive. I would focus on companies with strong governance improvements, rising shareholder returns, and exposure to yen weakness through exports. The remaining 10% I would keep in cash or short-term bonds for flexibility. This allows me to add to positions during market weakness and provides a buffer against unexpected liquidity needs. One important note about implementation: I would build these positions gradually over 6 to 12 months rather than all at once. This is not because I am trying to time the market, but because it reduces the risk of putting all your capital in at an unfavorable moment. Dollar cost averaging, where you invest a fixed amount at regular intervals, removes emotion from the process and ensures you buy more shares when prices are low and fewer when prices are high. For gold specifically, I prefer a mix of physical gold held in allocated storage and gold ETFs for liquidity. The ETFs are convenient and low cost for trading, but physical gold has the advantage of being completely outside the financial system. In a true crisis scenario, that independence may prove valuable for AI infrastructure. I would use a combination of individual stocks and thematic ETFs. The individual stocks give you exposure to specific companies where you have conviction. The ETFs provide broader exposure to the ecosystem without requiring you to pick individual winners in every segment. For Japan, I would combine broad index exposure through ETFs like the eShares MSCI Japan ETF with individual stocks where I see particular value. Currency hedging is a consideration here. I generally prefer unhedged exposure because part of the thesis involves yen weakness helping Japanese exporters, and hedging removes that benefit, but this adds currency volatility that some investors may not be comfortable with. Here is what I want you to understand about this allocation. It is not conservative. It is not designed to minimize volatility or track a benchmark. It is designed to generate exceptional returns over a 20-year period by owning the right assets at the right time. If you want average returns, own a broad index fund and accept that you will earn what everyone else earns. There is nothing wrong with that approach. It is simple, low cost, and effective for most people. But if you want to do better than average, you have to be willing to think differently. You have to identify opportunities that others are missing or avoiding. You have to concentrate your capital and your best ideas, and you have to hold on through the inevitable periods of doubt and underperformance. That is how I built my track record. That is how I generated billions in profits for my investors over 3 decades. And that is the approach embedded in these 3 assets. The next 20 years will reward investors who position themselves correctly for the major forces reshaping the global economy. Fiscal deterioration in developed nations will benefit gold. The AI revolution will benefit infrastructure providers. Japan's transformation will benefit patient investors willing to look beyond the past 30 years. I have spent my entire career trying to identify these transformational moments before they become obvious to everyone. Sometimes I have been early, which felt like being wrong until it suddenly felt like being right. Sometimes I have missed opportunities entirely. Nobody gets everything right. But I am confident in these three assets. I am confident in the fundamental analysis underlying each choice, and I am confident that investors who position themselves accordingly will be rewarded over the next 2 decades. I have seen many economic cycles in my career. I have seen bull markets that seemed unstoppable and bear markets that felt like the end of the world. I have watched fortunes made and lost on the basis of positioning and conviction. Through all of it, the one constant has been that fundamentals eventually win. Prices can deviate from value for months or even years, but eventually, reality asserts itself eventually. The assets that are undervalued rise and the assets that are overvalued fall. Gold is undervalued relative to the fiscal trajectory of developed nations. AI infrastructure is undervalued relative to the transformational impact this technology will have. Japanese equities are undervalued relative to the corporate governance improvements underway. All three represent opportunities where patient capital will be rewarded. The question is whether you will have the courage to act on this analysis or whether you will do what most investors do. Wait for confirmation, buy after prices have already risen, and wonder why your returns are disappointing. Fortune favors the bold. It always has. The opportunities are there for those willing to see them and act on them. 20 years from now, you will look back on this moment and either be glad you had the conviction to position yourself correctly or regret that you let the opportunity pass. The choice is yours.